Welcome to another episode of Income Fund Fundas, Simplifying Debt Markets, hosted by yours truly Sunil Javeri and brought to you by Axis Mutual Fund. Continuing with our queries on liquidity aspect of a portfolio and how do you gauge them. Another question, and a very interesting question: what should be some guidelines on investing in schemes which have managed liquidity aspect of a portfolio well? What we had covered earlier was the pointers on how to gauge whether a portfolio has liquid papers or illiquid papers. Today I'm going to discuss about what kind of a portfolio will have better liquidity than the others and which are the pointers for that. Exposure to widely held issuers. Identifying such issuers which has more acceptability will ensure that there is less of liquidity risk in that particular portfolio. Another criteria to look for is exposure to large borrowers. So selecting schemes which has exposure to large borrowers and large corporate houses will also ensure that the liquidity risk is mitigated. So these are some of the pointers which I have just pointed out in terms of how to mitigate the liquidity risk, either through a portfolio which will have issuances by the widely accepted borrowers or issuances by large borrowers, and that will ensure, as far as the investors are concerned, that their liquidity risks will be mitigated to a large extent. Thank you so much. Mutual fund investments are subject to market risks. Read all scheme related documents carefully.